Hello and good morning, listeners. It's Friday, or as many of us must be saying, TGIF. This is Almus Market Mornings with Shikhar Garg, and let's dive into the updates from the data heavy second half of the week. We've had the Eurozone inflation data released, which was higher than the estimates at 8.6%, though it has been lower than the previous numbers. Interestingly, Japanese inflation was also released yesterday, and it was, although lower than what was estimated, it is still at a 41 year high, just slightly below 4.2%. Not just that, we also had few comments from the incoming governor of the Japanese central bank. So JK, I'd like your thoughts on what's exactly the commentary from the governor mentioned, as well as your expectations on the market activity from today's set of data, be it PCE or anything else.
Yeah, good morning. I think markets focus has now shifted single-mindedly on inflation and monetary policy. We had those minutes from FOMC and then RBI also, which actually reaffirmed that central banks are not letting inflation take its hold, and they will be on their job of containing inflation. So that's what they were looking for. Eurozone inflation came slightly higher at 8.6 for year on year, and also core came at 5.3 versus 5.2. So it was a fresh high for the core CPI, no doubt. And the worst part of it is that the services CPI had jumped to match a record high at 4.4%, which is not visible in the headline, and that's something that should be concerning the Eurozone officials. Then Bank of England official Mr. Mann said on Thursday that it was soon to say the risks posted by huge surge in inflation last year had been erased, and that the central bank should continue to raise borrowing costs. Till recently, market had been assuming that Bank of England may be closest to ending their rate hikes, but this he has put a spanner in the works. Yields moved both ways in the US session, initially moving higher after GDP data showed that price pressures were increasing, and also the jobless claims coming lower at 1,92,000 versus 2 lakhs expected. But later, as key levels on the top side held, investors were seen buying back treasuries, and the profit taking on shorts and value buy on the treasuries were the reason behind this marginal lower yields yesterday. But basically the yields have been moving in a wide range, and so we are at the top end of the range, so we might see some consolidation before we get more clues on the inflation. We should, of course, we also have the PCE core inflation numbers on, and also the personal income and consumption that will be released today. Consensus forecasts have income rising 1% and consumption up 1.3%, consistent with the big gains that we have already seen in employment and also the retail sales. Unfortunately, the core inflation is also expected to go up a little in line with the previous CPI data, and the consensus has the core PCE up at 0.4% and year-on-year rate slightly edged down to 4.3 from 4.4, but definitely any deviation from these numbers will have some market reaction. Yes, we have been focused on what the new BOJ governor we will be uttering, and he has been uttering a lot of things, and most of it so far has been on known path that the Bank of Japan has been following, and there is no quick change in the monetary policy that he is contemplating, and so they are definitely seeing to it that there is no disruptive change to the monetary policy. Only significant statement I could see was that one of the ways in which they could see in the shift to monetary policy was to focus on 5-year bonds instead of on the 10-year yield curve. So we'll have to see how this pans out in the coming days. But it's a long testimony. It goes on for another hour or so today, and then on Monday he will have another hearing in the upper house of Japanese parliament. So it's not going to settle down till then. For stocks, it was a topsy-turvy day with major indices in the US mostly staying in the red but recovering later, with market still discounting the higher for longer, while some value buying was also seen. GDP coming at 2.7% versus 2.9% expected, even as PC price indexes rose. That was actually initially a negative for the market, and then later on, lower GDP probably prompted them to buy back some stocks. I think one more reason is that S&P 500 went below the 50-day moving average, so some technical bounce was also justified in the market. Overall, the price action reflects it's an edgy market that remains uncertain on the outlook, not knowing which way to go. On the dollar, it was a lackluster day mostly. In a slow-moving market, dollar did strengthen, particularly against the euro and yen, but definitely lacked momentum. Feel that more directional indication could come from tonight's PC inflation data, and if that doesn't move the market, then we really have to wait for the jobs number next week. On the rupee, there was some strength seen in the market, mainly driven by sell-off in the crosses, INR crosses like Euro INR and GBP INR. These crosses have moved substantially in the last 1 year. Euro INR, for instance, from 77.70 to 90.50, it's a move of more than 16%. We are seeing some profit taking in these cross INR positions, and also, as we mentioned yesterday, with INR also below 100 on the RER, there's some value buying in INR possibly, or profit taking on these long positions that is again driving. So nothing major as a directional. So might be some more action on this front from investors and traders can take the dollar rupee down to 80 to 40, which remains key for some more gains towards 82. But it's going to be a slow market. It's not going to be a very big directional market. Finally, I'm also looking at the fact that G7 and Biden are likely to impose fresh sanctions today on Russia, and there is a mechanism that is going to be set up to ensure that compliance with the sanctions. And from Indian point of view, we should be slightly not ignoring it, because we also have been importing a lot of oil from Russia, and payments are being made in various currencies. So hope that it is not affected by any of these sanctions by G7. Thank you.
Interesting, JK. And yes, folks, we have been seeing the shift in focus, or rather the commentary of the incoming governor of the Japanese central bank mentioned that there is an option of shifting the yield target to a 5-year benchmark versus the 10-year benchmark. Apart from that, as we can see, the market has been fixated on the or have been focused on the monetary policy response by the central bank, as they continue to be determined in their attempt to bring the cost pressures under control, even if it costs some dent on the growth. Apart from that, it needs to be seen how the PC numbers direct the currency action. If not, we definitely have the next week's jobs number, which can give some sort of a clues. But other than that, these sanctions, as JK mentioned, would be critical to watch out for, as the geopolitics also haven't reared its head on the backseat. Rather, they are continuing to be another influential point in the financial markets as of now. That's it for today, folks. We shall come back again on Monday with another round of updates. Thank you so much for listening.